Hello, Yolanda.
Hello, Theo.
It's certainly been a difficult few months in financial markets, and I do think there's a reason for investors to be anxious. Markets have been volatile. We're seeing news coming out, various angles of news, talking about various risks lying ahead, and I think we need to address these, and we need to be careful not to get swept away by media reports. Remember, media's key focus is to sell a newspaper or to get eyeballs on their website or to get viewers for television revenue. So they will highlight what people will look at. Nobody will say that there was yesterday 30 planes landed safely at OR Tambo. They'll rather say one plane skidded off the runway. So one must be careful what news and what's not news.
And we're certainly living in a very different world, I think, than what we were a year ago or even 6 months ago. You know, inflation has become such a problem worldwide and stickier than everybody expected. Everybody around the world is increasing the interest rates, and that has a huge effect on monetary policy and how people think about investment. So I've heard a journalist saying that everybody in the last 16 years have never experienced the environment that we're currently in. They've never experienced inflation. Interest rates were either zero or negative. So investment in an environment like that is very different to investment in an environment like we're in at the moment. In South Africa, we're possibly a little bit more used to that kind of environment, but for offshore financial people, it's new. It feels new. So it's totally a risk-off environment, and it feels like we're moving into a recession mode, and that's the fear that everybody's asking us about. What is your take on that?
All right, you actually made a very valid and sound point. Remember, if you go back in the late 2005, 6, 7, 8, it was a run-up to the crisis, the subprime crisis. And after that, 2008, 2009, the policy of central banks, and I'm specifically talking about US and European central banks, the policy was to reduce interest rates all the way down, to keep the banking system going. Now that led to two things. Number one, low interest rates, so money became cheap. Now if money is cheap, it means all valuations are based on cheap money. Secondly, the markets and the economists were flush with cash. So money was cheap and cash was available. So for the whole period from 2008, 2009 until last year, the financial services sector, banking, economists, analysts, investors, was living in this world of free, almost free money. So money was priced close to zero. But secondly, it was available. So therefore, this was a whole world matrix that people made decisions in. But that was never normal. And we always heard that that is not the normal way. The normal way is more like what we had in South Africa. Interest rates give you a return. It's not close to zero. Cash is risk-based price. So what happened is we saw late last year inflation starting to pick up slowly throughout the world. So we started the year with inflation picking up, central banks starting to look closer to inflation, growth starting to pick up, and then we had the crisis in the Ukraine. And all of a sudden, the slow inflation progress started to shoot up. As an example, at some point last year, if you were an American, you could fix your 30-year home loan at less than 2%. Now it's 6%. That's the kind of quantum. So you could fix 30 years your home loan at less than 2%. Now it's 6%. That's the quantum. 2-3 years ago, the first world were kind of, and first world I mean specifically North America and Europe, we're used to inflation rates of 1 or 2%. All of a sudden now, 8, 9, 10, 11%. It's a massive difference. So what does that lead to? First of all, money has got a different price. The value of money is different than it was. Cash is not that available. Cash has got a price. But we also see long-term interest rates starting to move up, where the US 30-year bond at some point was less than 1%, closer to 0.5%. It's now more than 3%. So all of a sudden, there's your risk-free return is not 0.5%, it's now more than 3%. And that results in different valuation coming in. Now, where your point of recession or slowdown in the economy is coming, central banks are actively raising interest rates in order to dampen this inflation. If you look historically, inflation usually when it peaks, just as it caught the markets off guard, it will at some point come down. Now, that doesn't mean if something in America was a year ago $100, now it's $110. Remember, it's not going to go back to $100. It just grows slower. It goes to 111, 112. So that's what happens. And at some point, the reference point is the $110, not the $100. The point where I think we need to be careful in terms of the technical term of a recession. The US unemployment is as close to full employment as possible. The same for Europe. So the fact that the economies might slow down in terms of growth, people have got jobs. People are employed. So one must be very careful how you do it. But does it create uncertainty? For sure. Why is valuation struggling? Because of this uncertainty amongst other things.
That means all valuations are down.
Yeah. Valuations are down probably about 20% overall. Now, 20% again is a big shock for investors. But that's what's happened. Valuations are down 20%, and there's 2 or 3 factors in this. Number one, if interest rates keep on going up, the question is, what will the consumer do? What will profitability do? And how do you discount that profitability on the one hand? The second point is the alternative is starting to give you 3.5%, not 0, or close to 0. So there's that mix as well. And remember, when markets are uncertain, in uncertain times, valuations come down. The question you have to ask is 20% lower valuations. Does that discount the uneasiness, uncertainty? And to what extent does it discount the uneasiness or uncertainty? And that's a question that's playing itself out.
And again, the reasons for a downturn is different this time, but we always have these downturns.
We have volatility. And volatility in the short term, we're going to have to live with. One of the takeaways you have to realize is in any portfolio, there's different asset classes that will perform differently in high inflation, lower growth, uncertainty. But the key element is in the long term, you have to have sufficient exposure to assets that can grow in an inflationary environment. Now, what's that? It's something like if I have a herd of 100 cattle, next year there'll be 150. If I have a share in a company that is operating, the company has the ability to adjust to inflation. If you go to your favorite retailer, they'll push up prices. If you go to the bank, there's business being done. So therefore, you need to have instruments that can grow with inflation. And that's where your equity portion comes in. Unfortunately, that portion is also the most volatile. But in the long term, that's the asset class that can adjust for inflation as time goes on. And you need to have that exposure in order to beat inflation over periods of time. Yes, in the short term, it might not look great. The optics might not be there. But in the long term, you need assets that can grow, that can outperform inflation.
There was a very interesting article done by Carl Richards from the Behavior Gap, and he explains this up and down movement. He compares it to the sea and the waves in the sea. And he draws this picture where you've got this long flat line and then these waves. And the flat line, especially in the sea, is abnormal, right? Waves are normal. The problem is in offshore markets especially, we've had this long period of just upward movements and no waves. And then even a small wave would feel like a big hit, which we've had, and they're keeping on coming. But that's normal. And I think from our side, what we're doing is to make sure that the structure of the investments are correct, that the asset allocation, that the strategy per client is right, so that they can go through these volatile times. So whatever the reasons are, that when it's down, that you're okay. You know that you're going to come out of it. And like you said, it's businesses. They grow and they're up again. So for our clients, make sure that your strategy is correct. Make sure your equity exposure is not too high, but not too low either, because you want that growth when it comes back. That your offshore exposure is sufficient, but also not too much in certain cases, which of course, Theo, brings us to the rand.
Yeah. The point that you have to realize with the rand, this is a question of dollar strength we now. And why I say that is, let's go to the beginning of the year. The rand weakened by about 13% against the dollar from the 1st of January this year to where we are now. About 13% weakened. Against euro, we're stronger. We're actually stronger than the beginning of the year. And you know what? Against sterling, we're much stronger than the beginning of the year. So therefore, against the Australian dollar, we're exactly where we were the beginning of the year. So we must be careful to say this is rand weakness, this is dollar strength. We're living in a world where as the US hikes their interest rates, as their long bond starts to create real returns, money is flowing back into the United States. And that's why we have the strong dollar. Now, my experience in financial markets, anything that's at a 20 or 30 year high or 20 or 30 year low is going to, at some point, is going to reverse to some kind of mean. Where that is, I don't know. What the trigger will be, I don't know. But I've never seen a market at the 30 year low or a 30 year high remaining at that level. At some point, it starts to come back to some kind of reversal to the mean. So I think we need to be careful. This is dollar strength. The rest of the world's currencies are all down. It depends on the magnitude, but this is about dollar strength, which brings us then to the other point. If you are underexposed to international markets, what is our view currently?
So currently, with the dollar strength, you can be patient if you do want to take out dollars. But we can also take out money in pounds. In most of our portfolios, the underlying investments are made in pounds, euros, dollars, yen, all the developed world currencies. So you do have those currencies in your portfolio, and we just report in dollars, and we won't stop that. Because
so
that
even though the dollar is very strong, and it obviously the assets, the underlying assets, as we said earlier, is down about 30% in terms of world markets. The dollar's up 13 odd percent. That still gives you a negative see-through in the dollar portfolio. We're not going to change that, but the way to enter markets might be slightly different.
Yeah, and our level for the pound was always around 20.50 and lower, and currently it's 19.20. So a good level to take it out if you have cash available to take offshore.
Well, Yolanda, thank you very much. After this, I'll talk to Frank.
Yes, we're very excited to have him in our business and to welcome him.
Well, I think that shows that the business of Galileo is growing. But secondly, we're bringing senior people in that's younger than me and Warren and younger than yourself. And that is kind of creating the transition to next generation's leaders. Because remember, if we manage capital on your behalf, it's a 10, 20, 30, 40 year view we have to take on that. And we must need to make sure that if we take that view with client and client services, we need to take that view in our own business and make sure we bring senior, younger people into the business.
Yeah, and Frank is absolutely that, and a very strong person. So very excited to have him here.
Thanks, Yolanda. Frank will join me now.
Thank you.
Well, Frank, welcome. Frank Daubenton. You joined us now just more than a month ago. Welcome. A bit about your professional background, Frank.
Thank you, Theo. It's great to join Galileo Capital. So I've been in financial services for almost 15 years now. Most recently, I've had senior management roles at one of South Africa's largest asset management firms. And yeah, it's fantastic to be here.
And a bit about your background in terms of studies, academic background?
Sure. So I've studied a number of things. I have an undergraduate degree in theology and leadership studies, a number of postgraduate diplomas, one in financial planning law, one in entrepreneurship, and then I was fortunate enough to do my MBA at INSEAD in France.
And how did you experience that? How was it living in France?
It was fantastic. The croissants were not good for my waistline, but the culture was fantastic.
And a bit about yourself?
So I'm married to Abby. We have 2 boys, William and Joshua. And on the weekends I love to hike, surf, play tennis, and generally enjoy the outdoors.
Let's move to wealth management, financial planning. Your view on that?
Well, Theo, I think finances and wealth management and investments are all about how we use those resources to reach our dreams. And those can be our dreams for our families, our dreams for ourselves, our dreams for our communities. And so, what I think we do as a business is understand our clients' dreams and ambitions and goals, and then understand their current financial position. And only then do we put together a financial plan which helps them to ultimately achieve those goals.
And that's what we do. It's a journey. It's a journey that we want to take with our clients.
It's a journey that we want to take with our clients, and it's a long-term relationship we want to build.
Well, that's part of why it's important for Galileo Capital to keep on bringing younger people into the business in senior positions, because if we take the view of a journey, we also need to buy into that. Now, Frank, where will you be positioned?
Thanks Theo. Yes, so as you know, we service clients across South Africa from here in Johannesburg, but I will be based in our Cape Town office and look forward to welcoming clients there.
Frank, all the best, and we wish you a great journey. Certainly we're excited, and we look forward to you adding value to the experience and to build this business so that people can view this as a partner for 10, 20, 30 years. Frank, welcome, and thank you very much.
Thank you, Theo.